Welcome back, everyone. In this episode, we're going to be discussing Costco. Costco just reported their earnings, and the stock is up 4.5% as a result today. So investors like the earnings report, and that's on top of a pretty good performance this year. In fact, if we look at year to date, Costco's currently up 44.6%. So it's on a roll. It's having a really good year. And the earnings report was interesting. We had some special news. Costco announced a special dividend of $15 per share. This $15 per share dividend equates to $6.7 billion that's moving off of Costco's balance sheet into shareholders' hands. So what does this mean? What is the yield of the $15 per share? When is Costco going to do this again? What does this make their balance sheet look like, and how does it impact their financials? Why does Costco do this instead of doing buybacks? We have a lot to discuss in this episode. On top of that, we have all of the latest quarter financials of this earnings report into Qualtrim. So we're going to be looking at all the financials and fundamentals in visual format. We're going to go through all of this. And then finally, I also want to mention a couple things about Costco's valuation. It trades at a 40 forward PE ratio. That's on the high end. So I'll be sharing some thoughts about that as well. So this is going to be a very full episode. Let's go ahead and jump in. Now, I first want to start off by mentioning my history with Costco. In my portfolio, the passive income portfolio, Costco is one of the companies that I've held since the very beginning. So right when I started this thing, Costco was one of the very first buys, and it's a company that I still hold today. So I've held this one for roughly 5 years now. It's been a bit of a long holding, and it's up $20,000. It says 187% there. That is the money weighted or internal rate of return. The reason it calculates that is because my first buys of Costco were at a price below $200 per share. It currently trades at around $600 per share. So these first buys are up over 3 times. They've done phenomenally well. Now, I wish I had more money at the time that I was buying it so I could have done bigger buys. But what I've done is a strategy of buying the dip with Costco. Anytime the company dips down, I add more to the position. So that's what I've been basically doing with Costco over the years. That's led to a dramatic outperformance holding this company. It's been one of my big winners and one that I still hold. And to current day, I still believe that Costco is one of the best companies in the world. In fact, I've made many videos calling it the best company in the world. And I say that non-ironically. Costco is a company that's incredibly unique. It's one that rewards shareholders with enormous profits, beating the market for decades. It's one that rewards its customers with incredibly low prices and tremendous continual value. And Costco rewards their employees with industry-leading compensation. They're also a net benefit for cities. When a new Costco moves in, more businesses move in, more tax revenue. The cities do better as a result. Costco also works uniquely with their suppliers. They have very close relationships with the companies that work with them, unlike almost every other retailer. Costco is a unique benefit to society in so many different ways. I see this company as not just a good investment. I see it as a good thing overall for basically everybody that works with this company. They offer tremendous value for every party involved. And that is somewhat unique. There's a lot of investments where there's some winners and there's some losers. In the case of Costco, everyone seems to win. So obviously, I still love Costco. I still think this company's great. I think right now it's on the top of its game. It really is doing a great job. And investors are increasingly getting more on board with this company. It's currently up 4.5% on the day and up 44% year to date. So investors are very excited about the company now. They're bidding up the price. They're buying more of the stock. And that is in response of their latest earnings report. Costco just reported earnings, they beat on their EPS, and they came in line with their revenue expectations. None of that is all that exciting or even unexpected. It's basically expected at this point that Costco is going to continually grow their earnings. So nothing too unknown there. The big exciting or at least unusual thing is that Costco finally announced their special dividend. Their dividend this time is going to be $15. $15 per share. So you know how most companies announce dividends and they're like a couple cents per share? 20, 30 cents per share. This is $15 per share. That is a special dividend, right? A cash dividend. They give us a little bit more information on this, and I want to explain how this really works because there's a lot of misunderstandings about special dividends. The company announced with the board of directors that they declared a special cash dividend that's going to be $15 per share, payable January 12th, 2024. So if you're a Costco shareholder, for each share you own, you will get $15 in cash paid to you January 12th. of 2024. Meaning that for my stake in Costco, if we look at my current holding size, I own 81 shares, which is roughly going to be $1,200 in cash deposited in my brokerage account right there that I can then use for whatever I want. So that's what they're doing. They're giving us cash. But that also has some other implications. Where does this cash come from and how does it affect Costco? Well, the way that dividends work is a company basically comes up with a total amount that they're going to pay. In this case, Costco wanted to pay $15 per share, and that's going to cost them $6.7 billion. So Costco's removing $6.7 billion off of their balance sheet in cash and then putting that in the shareholders' pockets. And that $6.7 billion divided by the amount of shares outstanding amounts to that $15 per share. So the way to think of this dividend is similar to every other dividend, just on a much bigger and unusual scale. Costco's a company that generates a lot of cash. We'll be looking at this cash flow graph in just a minute, but last quarter was wild. They generated billions and billions of dollars of pure free cash flow, money that they really don't know what to do with. Costco has enough money to open up 20 to 25 new locations. They have enough money to pay all of their employees. They have more than enough. So what do they do with all that money? Well, they have it in cash. If we look at their cash balance over time, I know Qualtrim shows you this going back to 1985, so you can study the company. But what I want to do here is just zoom in over the past 2 years. We have the past couple of years here of their cash and debt. So there's 3 different categories. Cash that we have right here, and then we have long-term debt. This is like, it's just longer term, over 1 year debt. And then you have capital leases, which is in cases where they have to rent the warehouses. Costco likes to own their warehouses, but they still rent a number of them, about 20%. So we have the cash right here, and then we have their long-term debt and lease liabilities. Costco likes to stay conservative. They always like to have more cash than liabilities, and they do this intentionally. They know they could lever up, they know they could take out leverage, but they don't like taking risks. Costco likes playing things conservatively and never putting the shareholder at risk. So they always carry more cash than debt. Now, in this case, if we look at the past quarter here, Costco's cash balance rose up by billions. It went up plus $2 billion quarter over quarter. Not year over year, but quarter over quarter. That's a lot of money in a single quarter for a company like Costco. And here they are sitting with $17.86 billion in cash as of this most recent quarter. That's simply too much money. Now they don't just have excess cash, they have double what they have in liabilities. So Costco executives are sitting in these meetings deciding what they're going to do with this problem of having way too much money. It's a good problem to have, but it's still an issue. They have to do something with this money. They have the option of either sitting there and keeping it in cash, earning 5%, but 5% is not the best returns for a company like Costco. They like earning much better returns than 5%. They could pay off the remainder of the debt, so they could use all the cash to pay this down, but the debt that they currently hold is at a lower interest rate than the 5% they're earning on cash. So that's also not a smart financial move. They could venture into different investments and start being undisciplined and taking greater risk, going into different pet projects, but they don't want to do that. They like being conservative, not risk-taking. They like doing things that only have an expected high ROI. So they're not going to go and venture and do a bunch of little pet projects. Costco also could do buybacks. Like a lot of companies, they like buying back the shares to increase their earnings per share. But is it the best time to buy back Costco stock when the company's trading at a 40 PE ratio? And does that best serve shareholders? Costco management buys back just enough shares to offset dilution, but they don't like doing aggressive buybacks because they know not every shareholder wishes to use the cash to buy back the stock. So what they decide to do is a dividend. A special dividend, which removes a ton of the cash here and simply puts it in the shareholders' hands. That's all this dividend does. Minuses out money here and moves it into the shareholders' hands. Now we can calculate exactly how much this is. Right now, Costco has roughly, let's just round up to $18 billion in cash. The special dividend is $6.7 billion, which makes that around, I think, $11.5 billion, right around there. So this portion right here, that is the special dividend. They're taking this big pile of cash, they're giving that to you, the shareholder, in the form of $15 per share in cash. Now, a couple things I'll point out with this. First of all, Even after paying this special dividend, do you notice something here? Costco still has a nice bit of margin between the amount of cash they have and the amount of debt. So even with paying this enormous $15 per share dividend, the company's still unlevered. They still have net cash. That is incredible. A lot of companies, they would want to go further. Costco could bump this up to $20 per share. They could even bump it up to $30 per share, and they'd still likely be fine. So they could really return a ton of cash back to the shareholder, but they like to play things a little conservatively. So they're using a portion of that cash beyond the debt that they carry, and they're returning that back to the shareholder. I think a very wise move by Costco. So the nice thing for us investors is even after forking over all this money, even after paying this huge special dividend, they still have a balance sheet that's superior to the majority of companies in the S&P 500, vastly superior. Now, this also has a couple other implications. Like I said, the option was to keep the money in cash. They could do that, but cash is earning 5%. So they're paying the money now to me, the shareholder, where it's going to go into my brokerage account. I have it right here. It's going to show up with $1,200 as buying power. And then I can try to, with that money, reinvest it elsewhere to earn above 5%. That'll be my goal, is to get that money and earn not just 5%, but to earn 12 or 15% with it. So do you see the exchange there? By removing it off of their balance sheet, you're unlocking that money so I can reinvest it into other companies and earn a higher ROI. I think that's a very good exchange for the investor. So that's all a special dividend is. It's money the company has in excess cash that they're giving to you. Instead of the company earning 5%, you can try to reinvest that capital at a higher ROI, which I'm going to try to do. So overall, I do think it improves the returns because of this exchange of cash. Now, there's a couple other questions. How frequently are they going to do this? When have they done it in the past, and when are they going to do it in the future? In this case, we can see the history of the special dividend there. And these numbers are obviously off. We have the latest one coming in here. That'll get updated. But right here, we have a history with these special dividends. Notice these huge spikes. All of these are special dividends in Costco's past. In 2012, they did a $7 special dividend. Then in 2015, they did a $5 one. In 2017, they did another $7 one. Then they waited a greater amount of time in 2020 doing a $10 special dividend. And then this one, if we were to benchmark it here, it would be basically all the way up here. This one's going to be $15 per share, so way up above these ones, a big increase in special dividend over the course of 4 years. Now again, we can see the impact that these previous special dividends had on the balance sheet. So if we go back to the balance sheet, we can zoom out from the past 2 years and we can go to the past 5 years, because we know the past one was in 2020 right here. And we can see the impact. See what happened here? This cash balance decline was because of the special dividend. So you can see them chunk away at their cash right there, and then they rebuild it. They did some CapEx, so this wavered around for a bit, but once their cash gets too high, they decide to do another special dividend. I believe the special dividends are going to get bigger and more frequent because Costco is at such great scale now that they're generating greater and greater amounts of free cash flow, even as they build their warehouses. So I'll go ahead and explain why this is the case. We can look at the most recent earnings report with their free cash flow. Zooming in the past 10 years, we see that it was a record-breaking $3.61 billion of free cash flow. The highest that they've ever had before were those enormous quarters in COVID when they had to shut things down. Everybody shopped at Costco. That was $3.4 billion. So they even beat those peaks. This is an increase in cash flow of 132% year over year. So massive increase in free cash flow, just mind-blowing amounts of free cash flow, over $1 billion per month from this company. Now, they're not going to earn this much every single quarter because they're going to pay for more warehouses. But one thing that's interesting about Costco is this company has a strategy of opening up the same amount of warehouses every single year, not a percentage-based amount, meaning that every single year they open 20 to 25 different warehouses, even as their cash flows go up over time, which means overall the margins of the company increase because their percentage of CapEx is going down as the amount of warehouses stay flat and their revenue grows. So we should see an increase in free cash flow at a more rapid pace than we have throughout the past 10 years. So Costco is one of these companies that I believe will continue to generate increasing amount of free cash flows every single year in a predictable fashion. Because of their scale economies shared, because of the strategy and opening up their new warehouses, they're getting better and better at these things. They have it down by now. They know how to pick locations. They know how to source product. They know how to do all of this. So they're just executing the same blueprint over and over again across the globe. And we're seeing the results of this. Now, there's other reasons that I believe that Costco is a compounder. And one of them is the way that Costco is continually able to drive top line growth. Here we have a chart of their overall revenue quarter by quarter. And you can see the trends over time. You can see how smooth this is on a quarterly basis, growing between 6 to 12% every single year, all the way back since 1985. We're going back 30, 40 years on this company, and they continually grow. Now, if we look at this on an annual basis, you can see the picture a bit more clearly. It's just incredible top line growth. There's time periods where it speeds up a little bit, slows down a little bit. It's not perfectly, unnaturally consistent, but it shows a company that is exercising the same blueprint over and over again and doing it really well. This is the definition of a compounder, a company that can continually gain momentum, keep the gains, and keep going year after year. And Costco has proven to not be a very volatile company in terms of its earnings, and it's considered to be very defensive, meaning even in difficult times, the company can generate revenue and generate earnings. So this one has a lot going for it, and I believe it's going to continue. So they're driving free cash flow growth, they're driving revenue growth, the company's in the best shape it's ever been in. Even after paying a special dividend, they're going to have excess cash. Now, the next catalyst for Costco that I've been waiting for is I believe Costco's long overdue for a price increase with their membership. As you know, a good portion of their earnings come from the membership, around 60%. So it's a big driver of the actual profits of the company. But in this case, I would not recommend to Costco management to announce a price increase right now. I think that since they announced this special dividend to shareholders, it would look really bad optically to increase prices on their members right after paying their shareholders a bunch of money. I think there'd be a better time to do it. So even though I think it's long overdue for a price increase, even though I think the membership offers tremendous value and needs to be increased, now's not the time to do it because people are going to do the juxtaposition of the membership price increase along with the special dividend. You'll see that in the headline news and it will diminish some of their reputation. So I hope that Costco management is looking at that and the potential optics of it. In my opinion, I think a price increase on membership is now off the table for 2024. I would expect to see it sometime in 2025 or 2026. Now, finally, the last thing we need to address is the valuation of the company. In any investment, I see two major risks in a stock. I see fundamental risk, meaning the fundamentals go through the floor, the earnings per share go way down, the margins collapse, some new threat comes in. That's all fundamental risk. That's execution risk of the company, competitive risks. Then there's the valuation risk, which is basically just paying too much for the future cash flows. Even if the company executes well, if you pay too much, you can have diminished returns. So we need to address that next risk. We know that Costco is a great company with great fundamentals, and I believe a very positive future outlook. But the valuation with this recent bidding, another 4.5% today, it's really gotten up there at a very brisk pace. Year to date, it's up 44%. Over the past 5 years, Costco is up 224%, not counting all of their dividends and special dividends. It's up even more. So this company really has provided tremendous returns, but it's now being bid up at a very fast rate. In fact, just a couple months ago, it was down to $500 per share. So it's really going up quickly. And if we look at the valuation of the company now on a multiple basis, Costco's trading with a 40 forward PE ratio, which of course is on the high side for any company. But even for Costco, this is looking like it's on the higher side. For example, I've paid attention over the past 5 years of the PE ratio that Costco normally trades at. It trades basically within a range of around 30 forward PE to around 43. That's about the range it trades at. So on any given year and just normal trading and inflows and outflows of cash and maybe a weak earnings report or a strong one, it jumps around down to around the 30s. Sometimes it might go a little bit below that, but around the 30s, typically a little bit above that. And then when it gets on the high end, it moves up to around 43. So right now we're definitely on that higher end, above the 44 PE ratio. Now again, We have the fundamental risk, which I believe is low with Costco, but we also have the valuation risk. If we're buying the company at a 43 Forward PE ratio, we have a low fundamental risk, but we have a heightened amount of valuation risk. It'd be preferable to buy the company around a 30 Forward PE ratio. We at least reduce the valuation risk a little bit buying it there. A way that I've done this in the past is for every company that I hold, I make a watch list on Qualtrim. Again, this is included as part of the Patreon. But one of the tools I built is called the Dip Finder. You see all your companies on the left here. You see their upcoming earnings. But then you see the Dip Finder, this tool, for every single company on your watch list. This shows you which companies are in a dip or which ones are in a price surge. If the companies are green and above 0%, that means the price is surging upwards. They're not in a dip. If the company's red, that means it's in a dip. And the lower it is below the x-axis, the bigger the dip is. Now in the passive income portfolio right now, obviously most companies are in a price surge. Almost all of them are in the green, moving in the positive. This year has been an enormously positive year for me. But I have one company that's slightly in the red. That is Canadian Pacific. Canadian Pacific is one of the companies that I'm actively buying. I've been adding to this position. And this is not unrelated. Part of the reason I'm buying Canadian Pacific, and I'm not buying more Intuit, Chipotle, or Costco, is because this company's in a dip while these companies are in a big price surge. And for me, I'd rather buy the company currently being sold off for the one that's out of favor and hold on to it and just wait until it eventually gets into a price surge. So this is the way that I do my buys. I like looking for the companies that I've already done all the fundamental analysis on. I've determined that they're great companies, but I want to buy them at favorable times when they're out of favor. In that case, it's Canadian Pacific. That company's not in favor right now. So I'm buying into that one. And I'd like to do the same with Costco when this company goes a little bit more out of favor. Right now, the company is at 21% above its 200-day simple moving average, which means it's like a rocket. It's so in favor, everybody's piling into Costco. So now is a time where there's a ton of enthusiasm in the company. What I'd like to wait for is when this goes below zero. When the momentum fades, when investors start to move into different bets, they move out of Costco, and eventually this goes all the way down to zero and even below zero. If I can buy Costco when it's trading below its 200-day simple moving average, now that doesn't happen that frequently with Costco. The company is a little bit lower volatile, so it doesn't trade down there too often, but I'm patient. I'll wait and wait and wait until this company goes below its 200-day moving average, and that's when I'll buy into the company. So that's what I try to do with my buys and sells. I try to buy the companies into weakness and hold the companies into strength. So right now, I'm not buying in new to Costco, but I am holding a fairly large position into 2024. I'm not selling it anytime soon. We could have a valuation correction. It could go from a 40 PE ratio down to the 30s. That could happen, but I'm just not too concerned about it. Over time, the earnings growth and free cash flow growth will be the major story for this stock. So I'm going to hold on to it. I'm going to collect my big dividend from it. And if you want to see what I do with that dividend, just follow the channel. That's all for now. Hope you enjoyed. See you in the next one.